In this video, we're answering the question, should you invest in the stock market right now, or should you be waiting for the stock market to crash or for a correction before you should invest? And the answer to this question actually depends on which type of investor you are. There's really two types of investors, which are passive investors and active investors. So passive investors are those who are just buying into low-cost index funds and don't bother themselves with picking individual stocks. And typically these passive investors take a percentage of their pay from every paycheck and put it towards buying shares of their favorite low-cost index fund. Active investors, on the other hand, are those of us who actually pick individual stocks. Now, active investing can often get confused with trading or trying to time the market, but that's actually false. See, there's a big difference between buying stocks because you think the share price will go up and buying stocks because you think they're undervalued. Now, of course, when you're buying because you think the shares are undervalued, it is your expectation that the stock market will eventually recognize the value and the stock price will slowly become more and more in line with that actual value. But the difference comes from whether you're looking at it and focusing on the share price and what it's going to do versus focusing on the underlying business and its value. The former is called speculating. And for the most part, in the long run, no one actually makes any money speculating. On the other hand, there's a lot of money to be made by buying business ownership at bargain prices, naturally. Now consider that as sort of a little side lesson, which I thought was appropriate for the beginning of this video so that we're all on the same page. But let's get into answering the question at hand. Invest now or wait? Now we'll start off by answering this question for the passive investor, that low-cost index fund buyer. So you may have heard the saying before that time in the market beats timing the market. And historically, this has been proven over and over again to be very true. And I actually did a video on this exact subject a little while back where we did a little analysis comparing the results of 3 hypothetical investors over the past 40 years. One of them just bought index funds every month, consistently month after month on autopilot, regardless of what the market was doing. Another one of them tried to time the market, so they saved all of their money and waited for the perfect time to jump in, but ended up having the worst possible market timing and bought in right before each of the crashes of the past 40 years. And now the third person also saved money while waiting for the best possible time to buy in, but this hypothetical investor happened to have impossibly perfect market timing and bought in at the lowest moment after each of the stock crashes of the past 40 years. Now I'll put a link to that video in this description, and it'll also be the end screen of this video you're watching now, and I'd encourage you to check that out and see for yourself. But spoiler alert, it turns out that the consistent approach beats even the impossibly perfect market timing investor. And I was actually completely shocked by that. Before making that video, I assumed that perfect market timing would win. Now for some of you watching, that will be enough proof just by itself that trying to time the market just isn't worth it, even if you do manage to pull it off. But my guess is that if you're watching this video and you're a passive investor, you're probably one of 2 types of people. Either you've never invested before and you're trying to decide whether it's best to wait to start because you're seeing that the stock market might be at an all-time high and thinking that it must be overpriced and it must be due for a crash or correction soon. Or you're already invested but you're considering whether or not you should actually be pulling your money out so that you don't lose any money in that potential upcoming crash or correction, and then redeploying that money right back in at the bottom of that upcoming potential crash. Now, if you're that first person and don't have any investments yet, my opinion is that you should not wait to get started. You should definitely watch that video I already mentioned, but also, if you just sit on cash or put your money into a savings account to sit there and wait, at most, what you're gonna end up earning right now on that money is 1% or maybe 2% if you're lucky, but not even. Meanwhile, right now, inflation is devaluing money by 2 to 4% every year, or potentially even higher than that. So sitting on your money and putting it into a savings account is actually going to end up causing you to have less buying power in the future. So although yes, stocks are maybe not the cheapest they've been in recent history, they're also kind of the best place you can put your money right now. And my prediction would be that because the yield you'll get with a savings account or by purchasing bonds is just so low right now, and the yield you can get with stocks is just much better than that, money is going to naturally continue to flow into stocks, and stock prices will in turn continue to rise. That would be my prediction. Who knows what'll happen though, and fortunately for me, making predictions about what the stock market will do is not how I make money in the stock market, and it's not how you should either. And so even if the yield you'll get with stocks is considered to be low compared to what has been historically possible, it's still a better and higher yield than you could be getting with the alternatives. Now it's important to remember that the stock market can go up in some years and it can go down in others, and your investment growth is not going to be consistent year after year. This image shows the returns for each year from 1926 up to and including 2020. As you can see, there's many years when the annual returns are over 20%, but there are also many years where the annual returns are negative. And in these years, the S&P 500 finished lower than it started the beginning of the year at. Now, over this time period that you're looking at, the average return was 8.02% if you don't include dividends, or 12.22% if you do include dividends. Now there's a difference between average returns and annualized returns. So if you invested $1 at the beginning of this period, with dividends being reinvested, it would grow to become $11,185.62. This would mean an annualized return, also known as a compounding annual growth rate, of 10.31%. Now the point of showing you this chart here is just to remind you that your investment account isn't just going to slowly and steadily go up and up. It will be a rocky road, and you need to be able to stomach the ups and downs. Now, if you're the second type of passive investor who has money invested, but you're thinking of actually pulling that money out and waiting for a crash, my opinion is that you shouldn't do that either. And here's why. First, depending on what type of account your money is in, there's likely going to be some tax consequences. And paying taxes is never fun. And if you're cashing out and paying taxes every few years like this, there's a good chance that even if you could correctly guess the top and bottom of the stock market consistently over your investing career, which is unlikely, the benefit of being able to do that would be minimized by all that money lost in taxes. So don't try to time the market, and also don't get panicked out of your stock positions. But the other thing about trying to time the market as a passive investor is that you could easily end up pulling your money out way too early and sitting on the sidelines as you watch the stock market continue to go up and up for years and years. And even if you did manage to call the top of the market and pull your money out right before a crash, being able to guess when the bottom would come in would also be very difficult. For example, at the beginning of 2020, when we had the pandemic scare and the stock market crashed, there of course would have been a ton of people who sold all of their stocks during all the panic with the expectations that it was going to get worse and that the market would continue to go lower, and only to completely miss out on participating in the sharp recovery right back to all-time highs. I would not be surprised if there's some people who pulled out at that time that are still sitting in cash and waiting for a crash. So now we're going to move on to talking about whether to invest now or wait if you're an active investor. But if you have any follow-up questions, or even if there's something you disagree with, please let me know in the comments, because I do respond to every single comment. Now for the active investors, those of us who pick individual stocks, the answer becomes a little bit different. Now again, active investing means buying individual stocks when you think they're underpriced. And by the way, if that doesn't make complete sense to you yet, that's okay, because I've linked a playlist in the top corner of this video that has a few videos in it which covers all of the most important fundamentals. So I would finish watching this one first, but then I would check out the playlist after, which will also be a link in the description, because that's going to catch you up to speed and it's going to be awesome. Now, active investors spend their time looking around for potential underpriced stock opportunities and also figuring out how attractive those opportunities actually are. And this really will not change no matter what the stock market as a whole is doing. Now, I'm going to show you a short passage from this amazing book called 100 Baggers, which is all about finding stocks that are going to increase 100x. Just because a stock market index, such as the S&P 500, is pricey, doesn't mean you should give up on stocks. Unless you're a buyer of the index itself, it's not relevant to the business of finding great stocks today. Let me give you a historical example. 1966 to 1982. The big picture crowd likes to cite this 17-year stretch as dead money for stocks. The Dow Jones Industrial Average basically went nowhere. This performance was worse than it appears because inflation was high during this period. Thus, you might conclude you didn't want to be in stocks. But here's what my research on stocks that returned 100 to 1 found. There were 187 stocks that you could have bought between 1966 and 1982 that would have multiplied your money by 100x. In fact, during that 17-year stretch, you'd have had at least a dozen opportunities each month to multiply your money 100x if you just held on. So even when the market as a whole is trading at all-time highs, there will still almost always be stocks trading at attractive prices. And so the active investor's goal is just to continue to seek out and purchase them. Now, with that said, check this out. An initial $1,000 investment growing for 30 years with $0 in additional contribution and growing at a rate of 10% annually would turn into just over $17,000. Now, using the same parameters, but instead using a 15% annual growth rate, your money would grow into just over $66,000. And it would take 21 years at this growth rate to get to roughly the same amount that you'd get to after 30 years with the 10% annual growth rate. If we do the same thing again, but we use a 20% annual growth rate, your money would grow to just over $237,000. And it would take 16 years at this growth rate to get to roughly the same amount that you'd get to after 30 years with the 10% annual growth rate. What this means is that a very strong argument could be made for just waiting around in times when you just can't find any decent investment opportunities. To put that in other words, if the best available opportunities that you can find only offers conservatively expected annual returns of 10%, and if you've decided that you're not investing your money unless you can get at least a 15% return, then you could potentially wait up to 9 years for that 15% returns investment that you're looking for and still be in the same position after 30 years from now that you would have been in if you bought the 10% investment right now. If your hurdle rate that must be met before you'll invest is 20% returns, then you can wait 14 years without making an investment. Does that make sense? I hope it does. Now, when you study successful investors like Warren Buffett and others who have the best investment records sustained over a long period of time, what you find out is that there has been multiple periods when they've gone years without making a single investment. And when they're waiting and not buying, they're not doing it because they're trying to time the market, but rather they're finding themselves unable to find any worthwhile opportunities, and just waiting for a better opportunity to become available ends up making more mathematical sense than just buying the most attractive looking thing at that moment. So the answer for active investors is don't accidentally get sucked into trying to time the market. Keep doing the same thing as always and continue to look for attractively priced stocks. And if you get to a point where nothing you find is attractive enough looking, it's okay to wait until there is. Check out this next video right here. Please give this video a thumbs up because it really does help me out. And I'm not a financial advisor, and this isn't financial advice. I'm just someone who loves investing and helping people move the finish line of financial freedom up to be just a little bit closer. And I'll see you over in this next video.